What's going on, everybody? Ryan Pineda here. In today's video, I'm going to be giving my friend Graham Stephan some advice on how he could have avoided his $2 million tax bill. To me, Graham is like the godfather of the YouTube finance space. He kind of set the tone for what people like to see, and there are many others following in his footsteps, including myself. And I'll tell you, for me, when I started making YouTube videos last year in May, much of it was influenced by seeing his success on YouTube before then. And thankfully, since being inspired by him to start my own YouTube channel, him and I have become friends. We even helped him buy his house here in Las Vegas. So it's been an amazing relationship and I love seeing his success. And speaking of success, he recently did a video talking about how he made $5 million in 2020. I don't know about you, the viewers, but whenever I hear that, to think that a YouTuber who talks to the camera and makes content for a living can make $5 million doing it, I'm still shocked. I mean, my life and my career have gotten even bigger ever since I started creating content and going really hard at social media. But $5 million to make content is still just something that I can't even fathom. It's crazy. But as I've gotten more and more into the game and I've developed relationships with other YouTubers and influencers, I've started to see that that is actually really common. There are many other YouTubers who are absolutely killing it, whether they're making money from YouTube AdSense, whether they're making money from sponsors, or whether they're like myself and they're building businesses from their social media platform. It's just crazy how much money you can make if you do social media right. But there's always the big catch once you start making a lot of money, and that's the IRS. Shortly after Graham made the video talking about the $5 million he made a second video talking about the $2 million that he owes. That's right, he's got to pay the government $2 million in taxes, which comes out to around 40%. Now, if you're new to my channel, you might be seeing that and saying, well, yeah, the 40%, that's standard for people making a lot of money. Like, I don't understand what the big deal is. But if you've been subscribed to my channel, then you know that we try and lower our taxes as much as possible in every legal manner. If you didn't know, I actually own a CPA firm called TrueBooks. If you want to get a consultation, I'll link to it below. But my goal is to really pay as little in tax as possible. And I would guess that's almost everyone's goal watching this video. Who wants to pay more tax if you don't have to? And all I can say is I have strategically done many different things throughout the years to lower my tax bill so I never pay anywhere close to 40%. And Graham actually talked about some of those things in his video about his taxes. I'm gonna touch on those later on in this video and give you my perspective on them because I don't think he wants to do them and I disagree with him. And I'll tell you, if I'm ever fortunate enough to pay $2 million in taxes, it's because I made some absurd amount of money. I just could not do all the things I'm gonna tell you about in this video to just write it down even more. So with all that being said, let's go review Graham's video, see the things he's talking about, and I'll give you my perspective on it and what I would do differently if I was Graham.
One of the reasons why I ended up owing a lot more money than originally anticipated was because I did not spend enough money.
So he's absolutely right. His frugalness did get the best of him when it comes to taxes. There is no way to lower your tax bill without actually spending money. Now, there are creative ways to spend your money that actually give you a good return where it's more like an investment instead of spending. We're gonna touch on those here in a minute, but I want you guys to realize that it's not good to save every penny if you're trying to legally write down your taxes. You gotta spend your money on the right things, and then you're gonna get double benefit. You're gonna pay less tax, but you're also gonna increase your business or your rental portfolio or all these things we're gonna talk about.
On the one hand, lease out a large office space and hire a dozen employees. I could buy a dozen 4K cameras and a $50,000 MacBook Pro computer to make these videos, complete with a Mercedes Sprinter van and a Gulfstream jet for travel.
So I spent about $100,000 furnishing our new office space. We got new cubicles, we got desks, chairs, all of that stuff. And then I spent about $100,000 on all of our studio equipment. That includes the cameras, it includes the audio, it includes the sets, the podcast, everything that you have seen on these videos. And if you've been following me for a while, you know that our quality has drastically increased in the last 5-6 months. And it's because I chose to invest a lot of money into production. But here's the big benefit to it. Because I spent $100,000 on my office, then another $100,000 for my studio, I now have a $200,000 write-off. And the thing is, had I not gotten that $200,000 write-off, I would have then paid $80,000 in taxes anyway. And here's how you gotta think about it. I essentially wiped out $200,000 in income that I had. And if I'm getting taxed at that 40% rate like Graham is, then I would pay $80,000 on that income. But because I spent that money and invested into my business, I now wipe out that $80,000 in tax because that's income that I don't have anymore. And so when you think about it like that, essentially all of this stuff really cost me $120,000 because I would have paid $80,000 anyway. But if I pay an extra $120,000, I end up getting all of this stuff and I don't owe the tax. And plus the $200,000 that I spent is gonna drastically grow my business. You don't think that all this camera equipment is gonna make me more money? You don't think that all this office equipment is gonna help my employees and build better culture and help us make more cash? It's all an investment back into the business and back into the economy. And that's exactly what the IRS wants. The IRS actually incentivizes you to spend as a business owner. If I don't spend that money and I just go cut the IRS an $80,000 check, who does that really benefit? It didn't create more jobs. I didn't spend any more money in the economy. It didn't help my employees. It didn't help you guys, the viewer. The only benefit was the government made an extra $80K, but the reality is the government and the country as a whole will be far better if I just choose to spend the $200,000. So that's why the tax system works that way, and everything we're about to talk about in this video is part of that same principle. But as it relates to Graham, maybe he doesn't want an office because he likes doing everything from home, but he could have definitely spent a lot of money on getting better equipment because this is stuff that he's gonna use for the foreseeable future. His career is on camera, so why not maximize it to the very best that you can do?
In most cases, eventually it will deteriorate and eventually it'll need to be replaced. So as a way to compensate you for that, they allow you to write off the value of the property over 27.5 years. For example, if you have a structure worth $275,000, they'll allow you to take $10,000 off as a tax write-off every year for 27.5 years. That means that first $10,000 that you make in profit from that property is completely tax-free.
Okay, so depreciation is probably the biggest thing that Graham needs to be doing, and it's the biggest thing that I preach to these other YouTubers and people making a lot of money. You could essentially write off all your income if you buy enough rental properties. And honestly, this is the whole reason I'm starting a fund. I'm gonna be syndicating money together and buying great deals with commercial, with multifamily, and those types of things. And the reason is depreciation. The bigger the deals we can get in, the more depreciation we can get, the more income we can wipe off of our taxes. And I plan to take high income earners like Graham and other YouTubers and real estate investors and people who are just making a lot of money and put them into my fund so they don't have to find those deals. We'll find the deals for them and then they can get the depreciation on their own by investing into the fund. And that doesn't even mention the other great aspects of buying real estate and investing in a fund. You're gonna be able to get appreciation, you're gonna get principal pay down, we're buying good deals, so there's instant equity. So there's way more benefits than just depreciation, but that's the immediate benefit. And if you're watching this video and that sounds like something that you wanna invest in, there is one caveat: you must be an accredited investor. And if you are an accredited investor and you want to get on our early waiting list, I'll link to it down below. You can just go to ryanpineda.com/fund. But I'll just say depreciation is the biggest thing that these guys are doing to write off income. When you look at Grant Cardone and why he has Cardone Capital and why he's buying so much real estate, it is to write off his income from all of his 10X, his books, his events, and all of those things. And it's just one of the reasons that why I believe real estate is the best investment vehicle that anyone can get into. Now, depreciation is one of those things that people agree on. It's a great thing. You know, business expenses like the office and studio equipment, things that you're going to invest into your business that'll make you even more money. Those are great, those are awesome. But Graham also talks about some creative ways that I've seen other people do that he's a little skeptical on. The first one he gets into is captive insurance. Now, I'll be honest, I haven't done a ton of research into it, but I have a lot of rich friends who do have captive insurance. I'm not gonna explain in this video how exactly it works, but I think once you make a certain income level, it's most certainly worth it. And I think for me, we might end up doing it next year in 2022. It has a lot of red tape, there's a lot of regulation, you gotta make sure that everything is on the up and up, but as long as you're compliant, it can actually save you millions of dollars if you're at the right level. And I think at Graham's current level, he shouldn't be dismissing this one just because of the red tape and the regulation. Just do things right, hire the right people, and if it saves you money and it's worth it, then why not? Another creative one that he talks about in the video are conservation easements. The example he uses is you'd buy a piece of land for $100,000 and then you would donate that piece of land for $500,000 and thus creating a $500,000 write-off. I have heard of people doing this. I personally haven't done it, but once again, I would not dismiss any of these things if you can do it legitimately. It's one thing to buy a piece of land for 100 and say it's worth 500 when it's really not. That will get you into trouble. But if you do get a great deal and everything's on the up and up, then why not do it? I've actually seen this done with another asset class that he didn't mention, which is art. There are people who buy art and then donate it for a much higher value than what they bought it for. And it's one of those things where art is very subjective, and so an appraiser can appraise it at whatever they feel it's worth, and that is the value of the donation. And I know it's one of those loopholes that rich people use, that if people found out about it, they'd be really mad, but I'm just throwing it out there. It's something that people do that is very gray area. I personally haven't done it, but I know people who have. Another creative one he brings up is Section 179. Let's take a look at that one.
That says that you could depreciate heavy machinery and business equipment 100% the first year if it weighs more than 6,000 pounds. Well, guess what? A Tesla Model X weighs more than 6,000 pounds. A Rolls-Royce Cullinan weighs more than 6,000 pounds. A Mercedes Sprinter van weighs more than that. A boat weighs more than that. And obviously a Gulfstream jet weighs more than that. So if you buy those for business use, you're able to write off 100% of the cost of what you buy entirely in the first year.
The Section 179 deduction is really great for those. My Tesla Model X cost about $90,000. The Lincoln Navigator cost around $65,000. Those are now both fully deductible for our business. It's also one of the reasons why wealthy people buy boats, why they buy jets. At the end of the day, they're gonna get a huge tax deduction for that year. But on top of that, if it can make them more money, if Grant Cardone can go fly around in his 10X jet and go buy more real estate and create this persona and make more money, then it's very easy to argue that yes, this is a business expense. I need to deduct it right now this year. So Section 179 is a great deduction. And honestly, Graham should have bought a big car like he talked about. He ended up buying a Ford GT for $300,000, which would not qualify. He would have been better off buying the Rolls Royce or one of these other cars that do. Or he could just buy them both. If you're making $5 million and you want the Ford GT and you want to just have this car that appreciates, but then you want to go have a toy that's maybe not such a good deal, go do it because it'll be a good deal with Section 179. But the reality is we all know cars are not a great investment, but this next one is the biggest thing that Graham needs to make sure he's doing because it is the best way to reduce your taxes while also investing. I'm talking about the cost segregation analysis.
Except here, you're able to depreciate some aspects of the property 100% the first year instead of waiting to do that over 27.5 years. In this case, when it comes to this, any item of a property that has a lifespan of less than 20 years could be written off 100% the first year you buy it.
So short clip, but super important. If you have an item in your property that has less than 20 years of lifespan, you could write it off 100% the very first year. So what has less than 20% of lifespan? A lot of stuff. The paint, the flooring, the kitchen. There's a ton of things that need to be replaced very often. So for example, if I spend $20,000 on a rental property in renovation costs, and I know that all of those have less than a 20-year lifespan, I can write off the $20,000 today. Now imagine that I bought a 100-unit apartment building with the fund I mentioned earlier, and say I spent $1 million in renovation expenses that are 20 years or less. That now means I've created a $1 million write-off just on those expenses, and this is still separate from the other depreciation. So you see how this can become really powerful when you buy big real estate deals. And so for me, my business model is actually changing from years past. It used to be I made the majority of my income from flipping houses, and then I would offset that income by buying single family rentals like my Airbnbs in Big Bear, like my properties in Vegas, and that would usually offset it enough along with reinvesting into my business. But as I transition down the path of influencer, the way you make money is very different. I can make money with brand deals, affiliates, with YouTube, and all of these things that I never made money before on. I'm also selling more education than ever because more people are aware of me and what I'm doing. It's very similar to the model that Graham and Meet Kevin and these guys have taken to grow their wealth. They're making money through their influence, essentially. They're not making it through real estate like they used to. Now, granted, they never did real estate to the level that we do it over here with investing, but the big difference is I plan to just double down doing what I'm doing in real estate. I'm taking all the principles from years of flipping hundreds of homes and applying it to doing bigger deals just to write off my influencer income. And I'm fortunate because I do have the team and experience to do that, whereas I know other influencers don't because they have so much time spent into building their brand. And that's why I believe the fund is gonna be such a big deal, because they're gonna need a place to park their money and get these cost segregations, get this depreciation, and get all these write-offs. And if you're watching this thinking it's a sales pitch, hoping that they all just join my fund, it's not. I've already talked to them privately. I'm just laying out the big picture of how to legally write down your taxes as much as humanly possible. Another thing I'll add to this while watching Graham's videos, he talks about the risk of an audit. To me, I'm not necessarily scared about an audit. If you're following the tax code and you're doing things the right way and you're taking every deduction that you're entitled to, there's really nothing to worry about. And if push came to shove and you do get an audit, you're just gonna have your CPA company do it. And all I can say is the worst thing that happens is they say, you know what, you shouldn't have took this deduction, Ryan. You owe us money. And then I write the check and I give them the money, and it is what it is. The only time you need to be scared of an audit is if you're doing illegal activities. Which is definitely not what I'm saying to do. And I should have probably put this at the beginning of the video, but none of what I'm saying is financial advice. Talk to your CPA. Talk to your financial advisor, because this is just all my perspective. And so what I'll say is Graham could definitely have a way lower tax bill if he just does better tax planning this year in 2021. He just needs to do a bunch of the things that we talked about in this video, some of the things he himself mentioned, and he won't have the same issue. But if he didn't want to do any of that and he just wanted to continue to live his life the way he's living it and still not pay any taxes, there is one alternative. And I already made a video about it. It's actually what Logan Paul is doing. He is moving to Puerto Rico to not pay any taxes. I'm not gonna go into depth about how all that works, but if you wanna see how you could pay no taxes by just moving to Puerto Rico, I'll link to that video down below. So that would be the number one thing I would tell you to do, Graham. If you wanna just keep your life the same way, you don't wanna do any of the stuff that we talked about, just go move to Puerto Rico and you're not gonna have to deal with any of it. We'll sell your house here in Vegas, not a big deal, you'll be all right. But anyways, I had fun doing this video. I don't do many reactions. If you guys want me to do more reactions to other YouTubers and things that are going on in the world, definitely comment below. And if you haven't already, make sure you go hit the like button. If you haven't already, make sure you're subscribed. Go follow me on all the socials. Till next time, peace.